In this week's update, China's stimulus blitz makes a huge difference. Long-awaited public show of support for uranium and the folly of consensus thinking. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information presented is general advice only and takes no account of your financial position, objectives or needs. Before acting on any advice, consider if it's appropriate for you, and past performance should not be taken as an indicator of future returns. And of course, when investing in the stock market, you can suffer loss of funds. All right, let's get into it. Plenty happened last week. It was generally positive, but plenty of volatility. So starting with a global perspective, there are always dangers. So for those viewers that want to say, yeah, but what about this and what about that? And there are certainly some very significant dangers out there, but there always are, and there always will be. So you've got to look past that at the balance. And there are also many positives to outweigh those potential dangers. China has lobbed a huge stimulus during the week, and that's made a big difference to certainly the Australian resources sector, but also to commodity prices. And often these things can be the catalyst for a turning point. And mining's had a pretty tough time of it the last year or two generally. So that was certainly a big event. We also saw late in the week the US GDP for the second quarter. They go through a number of revisions. This was, I think, the third revision, but it remains strong at 3%. So in the US, there is this unlikely outcome if you go back 12 months, it was very difficult to say that the Fed would get inflation under control. They would do it while maintaining a pretty strong economy, and they would have the luxury of being able to reduce interest rates to get ahead of the curve on employment. And yet that would appear to be exactly what they've done. So it's pretty close, as ideal as it ever gets, it's pretty close to an ideal environment for stocks in general terms. But we still are seeing massive bifurcations in the market. We've got stocks that are going up at a very high rate, and we've got stocks that are going down at a very high rate as well. So it just gets back to astute stock picking, it always does. We've now got the Fed rate cuts. It was a big cut of 50 basis points, but also the forward intentions to cut another 50 basis points before the end of the year, I think was probably not universally expected by the market. So that's a positive. And there's even a bit of chat now that the next rate cut could be 50 points as well, and then another one in November. So it's all very positive for stocks. And then, of course, we've also had a bit of a kickstart to the nuclear theme again. I'll come back to that, but certainly some real positives that are a game changer. Nuclear has been, or uranium has been struggling a little bit over the last few months after hitting a peak earlier in the year, but it appears to have turned around quite nicely. So the lessons that we can take out of this, and this is always the important point to get to, not just to look at the scoreboard and see what happened, but to actually understand what we can take from that. And one of the important things, it was another reminder to me, unless, I didn't need one, but another reminder to me that you've just got to remain flexible in your thinking as circumstances change. Now, when we look at the uranium chart in just a minute, uranium stocks have been struggling for some time, and going with the trend, it was easy to conclude that uranium was still in a very negative sentiment environment. But the circumstances have changed, and so you've got to remain flexible and change with that. So the position that I personally held on uranium a week ago or 2 weeks ago, I'm now changing with the environment. You don't want to get stuck clinging to a position. Never be too proud to admit that you got it wrong, and you've got to change your position. And you've got to be able to do it quickly. Avoid the crowd, avoid the consensus thinking, and when the evidence is in front of you, just be decisive and get on with it when the balance of probabilities shift. So let's go and look at some charts. Now, this is URNM, which is an Australian-listed ETF on the uranium sector. And you can see that we formed a series of highs up here from January through to May, and then the sector rolled over, and it rolled over quite decisively. You can see that with the speed that these moving averages turned over. You can see it in the number of red candles compared to green candles. Look at this section through here. It's almost universally red through there. So this was a very sudden downshift in the fortunes for uranium stocks. And up until a week and a half ago, you would have to say, with all these moving averages heading down, the 200-day has rolled over, the price is below all of them, you're entitled to be negative towards the uranium sector. But several things have changed, and we've seen a very sharp rebound, and for good solid reasons. And you can see the candles and the volume, the character of this chart has changed. It's changed when you look at the number of green candles compared to red. You look at the size of them. You look at the fact that they've closed on their highs. We've got gaps, which indicates real enthusiasm to get into the market. All the short-term moving averages now have turned up, and the price is above all of them, and the volumes are there to support it. So there's no question we've had a dramatic change of character in the uranium market in that very short period of time. And so you've just got to change your position. There's no point in sticking your hands in your pockets and saying, well, I reckon that uranium's going down, and just staying with that. You've got to be flexible. But I just want to touch on another point while I'm here. There are stocks that consensus thinking, conventional wisdom would say, you just have to own this. It's part of a well-balanced portfolio. And there are many, many examples. I could go through dozens and dozens of these, but I've just picked a couple in different sectors. The first one is Woodside. For years and years, we've been told that this is part of a well-balanced portfolio. This is a weekly chart. So Woodside has been heading down since September of 2023, so for 12 months. And the experts have been saying that for years. But my question, and the price has fallen from nearly $40, and we're now down to $24. But the way that I look at it is, why would I want to be in a stock that is going down when I could be in a stock that's going up, has got terrific upward momentum? So it's a real head scratcher for me that this concept of a balanced portfolio, in other words, it's okay to own underperformers. I don't get that. I really don't. My focus has always been on owning what is performing. And there is enough stocks and enough sectors that are always performing that you can get diversity in your portfolio. But get that diversity predominantly with things that are going up, and absolutely minimize the stocks that are not performing. It's like being stuck in quicksand. Why would you do it? So I don't understand that thinking. If we look at Star Entertainment Group, which is obviously been in the news this week, they're in all sorts of trouble. They peaked back in 2018. They were trading at about $6.35, and this week they finished at 25 cents. It's been a meteoric collapse. And it was only 6 months ago that I read several recommendations from varying sources that this was a buy, and it was a buy on the basis that it was trading at half its asset value when it was at 50 cents. In other words, the asset value was something closer to $1. Well, guess what? It's not at 50 cents anymore. It's at 25 cents. So that was the consensus thinking, and we'll just zero in on that. You can see just how sharply the price fell during the week. So again, another piece of consensus thinking that is just leads you down the wrong path. And finally, in another sector of the market, this is Lend-Lease, another company that is always sort of touted as being part of a good, well-balanced portfolio. Used to trade at $20, has been as low as $5.30, and may or may not be bottoming out at the moment at around $7. So again, I just posed the question, why would you own stocks in significant long-term downtrends just to have a balanced portfolio? It just does not make any sense to me whatsoever. Okay, let's turn to American stocks now. The S&P was up 0.6% for the week. The Nasdaq did a little better with some rebounds in some of the big tech stocks. The equal weight S&P was up slightly more, 0.8. The Russell, surprisingly, was down a little, but I can tell you there are hundreds and hundreds of incredibly positive upward trending charts amongst small caps in America. So it's a very productive market at the moment, but not universally so. There are many stocks that are still struggling. And the rotations into the small and mid-cap area of the market are really worth it. And so stocks that deserve to rise, that where the fundamentals and the valuation support the price being higher, and over the last several years, they've been held back because of the weight of money has just been flowing into the big tech stocks. And also, small caps always struggle when interest rates are rising or are high. Now that peak has been reached, those stocks that have the credentials and deserve to rise are now free to do so and are doing so. The US dollar index was a bit lower again, so we're still trending down there, 100.5. The 10-year yield didn't move during the week, and the VIX inched up a little bit, but not too much. So let's go and look at some charts. So we'll start first of all. This is the S&P 500 on a weekly chart. You can see we did close off the highs a little bit on Friday, but it was another positive week, and this is a very, very strong trend. RSP also did well and continues its pretty robust breakout, and it was in such a lengthy consolidation. It was consolidating from the end of 2021 until this breakout got confirmed just a handful of weeks ago. It's a very, very long consolidation. And normally what happens is that the next surge to the upside will go a fair way over a fairly lengthy period of time. So that's, it's not a prediction. That's just the balance of probabilities. But you stay with what's in front of you. And if the market changes again, then be flexible enough to change with it. So for anyone that's looking for a prediction about where the US market is going, for sure, you're not going to get it from me because it's not how it works. But at the moment, the balance of probability favours the US market now having entered a new phase, particularly for the small and mid-cap end of the market. All right, let me just scroll forward. Okay, to the NASDAQ. So there's the NASDAQ on a weekly chart. It's recovering, making ground on the S&P a little bit more quickly, but still below its highs that were marked back in the middle of July, early to mid-July. I always like to follow semiconductors because they're such a barometer of a healthy market, and we're seeing semiconductors starting to regain some momentum as well. And there's the ratio between semiconductors and the S&P. It's still pretty much line ball at the moment. So I think we're going to see an advance in the US market, but of a different character. It's probably not going to be led by the Nvidias and the Metas and the Amazons and those sort of stocks. It's going to be led by a different part of the market. But the overall would appear to be that the US market is heading higher. This is an important chart. This is consumer discretionary versus consumer staples, and we're certainly back into a positive footing again, getting back towards the top of this range. So this is the balance between the money that's flowing into the more aggressive sector as opposed to the defensive sector. And we're getting back up towards the top. And if we go and look at the individual sectors, you can see the big performer. This is a monthly chart. A monthly look back. The big outperformer over the last 2 weeks has been consumer discretionary. It has absolutely taken off, and particularly in the last week or two. We also saw materials do very well, obviously with gold going up, but also materials in America does include steel and aluminium and several other areas that really don't feature in our market indices. But materials have had a good patch, and then we've got communication services and technology just sort of turning down a little bit towards the end. And then consumer staples is in the middle of the pack. So there's no question that the American market money flows have turned to the more aggressive parts of the market. So that's a real positive. So while I'm here, let's have a look at the Australian ratios. Over the last quarter, so going back a little bit further, this is information technology has been leading the way for some time. It was struggling back in August. We had a bit of a downturn, but of late, it's turned up quite strongly. The banks have just come off in the last week or two. And last week, for those of you that saw that video, I did a bit of an analysis at a broad level of Combank, and just to highlight the fact that it's trading at historically high levels when the Australian economy is in a position where it's hardly conducive to those sort of multiples that the banks are trading on. So no surprise to see the banks under some pressure. We certainly saw materials have an enormous run, particularly last week. You can see that's a huge surge in materials, and that's on the back of the China stimulus. It's on the back of iron ore prices recovering, and also we saw recovery in the prices of uranium and lithium and even nickel and copper, of course. So some very significant positive moves there. Healthcare trending down a little bit. I suspect it's more about the money's coming out of healthcare to fund money going back into resources. So I don't think there's anything particularly negative about the healthcare sector. It's just the money flows are rotating. And of course, energy is at the bottom of the pack and still struggling. Okay, that's the US market. Aussie stocks, the Australian dollar was higher again at, I think that should be 68.4, beg your pardon. Our market, our index was flat for the week, but there were some pretty major moves when you look under the hood, as we just did, and I'll go and look at the absolute sector charts in just a minute. We've looked at Star Group, copper, uranium, lithium, and even mineral resources did pretty well last week as well, with the bounce back in both iron ore and in lithium. It was the China stimulus that really got things moving, and this is sector rotation at its ultimate. When the circumstances change, the money flows can change very, very quickly and very significantly. The materials rise, as we'll see, was very emphatic, and what you can take from that is that there's the balance of probabilities again means that there is almost more to come. So let's go and look at those charts. So we'll start first of all with materials. So that's on a weekly chart. You can see we were looking extremely negative on the week ending the 6th of September. So no question resources were under pressure and were heading down, and that was quite negative. Let me just take these last couple of candles off. So things were looking pretty negative at that point in time. You would have been a very brave person to have been putting new money to work in the resources sector. But in a very short space of time, things have changed. And we got that week, which regained most of the prior losses. We then got a bit of a pause early, and then we've ended up with that in the last week. So it's an enormous rise in a single week. It's as big a weekly candle as you can see in this view, and that we've probably seen for a very long period of time. Now, again, that doesn't guarantee anything, but it certainly shifts the balance of probabilities that we're going to continue to see a surge to the upside. And if we just come down onto the daily chart, you can see just what last week looked like. It was extraordinary, and it was well and truly supported by volume. So, look, we might get a pause in this week coming after such a powerful week, but the odds are now that money flows are now firmly back into the resources sector. Here's the ASX 200. No real change across the week as a whole. Information technology did well in relative terms and also in absolute terms. Healthcare just a little bit down over the last couple of weeks, but nothing terribly dramatic there. The banks had been doing well, but that was a fairly emphatic reversal last week. And of course, energy isn't showing any real positive signs at all. All right, that's the Australian US markets. Turning to precious metals now, gold added at yet another $37. And at one stage, the futures were knocking on the door of $2,700. Finished at 26.59. Translating that to Australian dollars, there wasn't much movement because the Australian dollar is also going up, but we're still at 38.52, and that's enormously profitable for Australian producers. Silver also worked its way higher to 31.62. And look, all of these ingredients, the rate cuts, the stimulus from China, the tensions in many areas, the Middle East, Taiwan, Ukraine, you name it, there's plenty of them. All those ingredients have been there for some time. But, gold has just been working its way slowly higher, nothing spectacular, nothing that would reflect what the potential catalysts were. But we're now seeing gold and gold stocks starting to move at a faster pace. But when we look at the actual stocks themselves, there's a leverage effect. Typically in a bull market for gold stocks, they will go up at 3 to 4 times. I'm talking producers here. They'll go up at 3 to 4 times the rate that the gold price goes up at. We're not really seeing that leverage effect kicking in just yet. And of course, the better developers, the ones that really do have a very good story, will give you even greater leverage, and you can get 10, 15, 20 times sort of leverage to the gold price. But that's obviously a much more speculative and a much more risky area of the market. So that leverage effect hasn't really come, but past cycles will show you that eventually it does. So now is the time to be positioning in high quality gold stocks, whether they be producers, advanced developers, or early stage developers. Now's the time to be doing it. So let's just go and look at a few charts there before we move on. So silver, first of all, this is on a daily chart. So we did finish a little bit higher, but we hit a peak of 32.70. So that's a new high, and you've got to go back. You go back a long, long time. So we're back into 2011, 2012 area before we were last trading. So you can see that silver is now definitely on the move up. We've broken out, and we've had a reset, and now we're off again. So things looking very positive for silver. Here's the gold price in US dollars on a weekly chart. So a lot of strength. So we've had an excellent acceleration during March, bit of a sideways pause for a few months, and now we've taken off again. So that's looking very, very good. And in Australian dollars, that's how it looked on a daily chart. Now I want to go and look at the stocks. So this is GDX. This is the Aussie index for gold stocks, and it's looking quite positive. So we've now got a breakout above these highs all through here. So it's definitely trending nicely to the upside. There will be some resistance coming in around the $65 mark, but that's certainly looking very positive. But if we look at it on a relativity basis, so this is the Australian dollar gold price versus GDX. In Australia, and you can see GDX is starting to catch up a little bit, but it's not the way that you see it as it did back here, for instance, in 2020. Gold stocks have been lagging, and then when the shift comes very, very dramatically. We're not seeing that yet. We're not seeing that dramatic outperformance, but it's highly likely that it's coming. GDXJ is the other one to look at. So these are more globally orientated stocks. They're not the super majors, but they're the next level down of producers. Again, on a weekly chart, it was a bit of a nothing sort of week for GDXJ, which is surprising. So we're obviously just encountering a little bit of technical resistance here. Okay, that's the gold sector. All right, turning now to other commodities. Copper was higher again, so it's really shot back up from under $4 back to $4.53. Nickel also added about 30 or 40 cents, and crude oil slipped back again below the 70 mark. Now, lithium finally starting to roar. Is it sustainable? I think it's a bit early yet to say that, but the reasons that we've seen a sudden shift in sentiment to lithium stocks is CATL, which is a Chinese manufacturer, has finally suspended production. It's been talked about and expected for quite a period of time because they would have been losing money. Well, they've now suspended production. So that helps very much to reduce the supply side. The next thing that's happened is the investment houses have turned very bullish. I don't know whether that is correct or whether that's sustainable, that they'll hold that position, but that's the fact. A lot of investment houses have now turned bullish on lithium. They might be too early. Time will tell. Personally, I think it's too early to call a turnaround in the lithium sector. So I think buying for the long term in lithium, I don't see a green light there yet. But could you trade this bounce? I think yes, there's opportunities to trade this bounce with appropriate risk management. So yeah, don't go suddenly scrambling all in on lithium. I don't think we're to that point yet. But just make sure that you've got an exit plan if it all turns down again. And look, the fundamentals, the logical fundamentals are often misleading. The logic here is with supply being finally reduced, that things will suddenly get better. I'm not sure that logical conclusion is going to follow through just yet anyway. We've had a massive decline in the sector, both in the prices of lithium and also the prices of lithium producers. And you require, when you've had such a massive decline, you require a more substantial turnaround or evidence of a more substantial turnaround. So let's go and look at Pilbara Mines as just a proxy, so definitely not a recommendation here. But this is a weekly chart. And again, let's take these last three candles out and you get an understanding of just how dramatically emphatic this trend down was. And we had a very, very significant week down in the first week of September. And then that immediately turned around again and the volume started to rise. So that's the extra key thing there, that not only did we get a very, very positive candle that completely engulfed the previous week's losses, but the volume was up as well. Following week, we got a bit of a brief pause, and then we got very good follow through the following week. But again, just step back. We've only just made it back to the 200-week moving average. The 20-week and the 50-week moving averages are still strongly pointing down. Now, this is a weekly chart, so it takes a lot more to turn this. But nevertheless, I think given the decline that we've had, where prices have more than halved and gone down 80, 90% in some of the underlying commodity prices, then you need more evidence than just a couple of weeks. We've only just come back to the 20-week moving average. So there's still quite a way to go. So that's why I think risk management is important rather than just, grasping at straws. And for those that have been waiting to get back into the lithium market, because I know a lot of people were very heavily exposed to lithium and it hurt them. It hurt them very badly. And so there will be a natural inclination not to want to miss out and to stampede back into lithium. And I just think it's too early to do that. All right, other commodities, uranium. So what has changed there? Well, several things. So there's certainly more to the fundamental shift in uranium. Microsoft have done a deal with Constellation Energy for the supply of nuclear power for data centers that Microsoft are looking to obviously build and operate. And so I think that is a sign of a new trend where there's going to be more of a commitment from these mega tech stocks towards uranium. So that was a real positive. The real positive for me is that a group of investment banks, and I think there's about 14 of them, have now pledged funding support to assist the tripling of nuclear capacity by 2050. That's a very, very significant change. The absence of that commitment by the major investment houses has held the uranium sector back. Funding has held mining in general back for several years. So that is a huge positive for the nuclear industry. Now, it doesn't mean that there's not still risks in projects, risks in construction, and they do take a long period of time. to construct a new nuclear power plant. But this is a huge step forward for the uranium sector, and stocks are responding. The question is how to play it in the next 12 months, because the long-term 2030, things should be looking pretty buoyant. Through to 2050, things are going to be looking ultra buoyant. But how will it go in the next 6 to 12 months? That's the question on my mind. There is more reason for the uranium stocks to rebound than there are, for instance, lithium stocks. I think that's a more solid footing. But, who knows? I still think risk management here with uranium stocks is paramount. And there's the spot uranium chart. So the renewed enthusiasm in uranium stocks is not due to the spot price, but the spot price is only a very, very tiny fraction of the price discovery process globally. Most of it is done under which we don't have visibility over. So it's not come from a surging spot uranium price, but who knows, that might be the next thing to follow. So certainly a sector to start to look more favourably upon. And 3 weeks ago, you couldn't have said that. So there's definitely been a shift, and this is the time where you've just got to be flexible in your thinking, acknowledge that there's a change. It's probably a fairly dramatic shift, and to go with it. There's the spot copper chart. So you can see we've had a good 2 or 3 week rise there in spot copper. Wrapping it all up, the concept of group thinking, and I touched on this earlier, there's a lot of group thinking in the industry, in the professional parts of the finance industry. I've never found it to be a helpful source of information, what everybody else thinks, what the majority thinks. So I tend to run the other way pretty quickly when the consensus view is that you must own XYZ stock. And I showed you some right at the start that bears that out. There is no substitute for just proper stock by stock analysis. Respect the trends. Don't get stuck in stocks that are trending down strongly over long periods of time. And just pay attention to risk management. That's what we can control. We can't control some things in the market, but we can control risk management and our weightings and our stock selection. So just do that and make sure that you've got a portfolio which is spread across as much as you can, just good performers that have got a great outlook. So find a way to work outside the groupthink crowd, whatever methods it is you use to identify stocks and manage stocks. Just find a way to do it on your terms and not be drawn into what consensus thinking is. Portfolio analyst last week, we looked at uranium stocks with very good reason, and also just why sectors go through cycles. Why does money rotate from sector to sector? So that was a very interesting session. Some more information on the website. There's my email address, and I'll be back with you next week. Cheers.